Recording started here. All right, good deal. So once mortgage 101 for agents, it is, it can be useful for new agents, of course, but it's really just a good refresher for anybody. Um, my name is Jay York. I am a licensed loan officer here in North Carolina is where I'm based. I am licensed in North Carolina. I'm licensed in Pennsylvania, Louisiana, and Maryland right now, so that I'm licensed in. And a little bit about me: I am with CMG Home Loans. So CMG Home Loans, we have been in business since 1993, newer to the East Coast. So right now in the Charlotte area, I think we have maybe like 4 or 5 loan officers here. We have some in Raleigh and some in North Carolina, in South Carolina. So for us, it's a great opportunity to be able to come in and provide value. Obviously offer a lot of products and just some different things that are really great from a partnership perspective that we can really help you guys leverage in business. And the name of my team specifically is the Closing Table Collective. So with the Closing Table Collective, um, what we look to do is establish a real estate ecosystem that is designed to really help buyers, investors, and industry professionals build long-term wealth. So I've been in the mortgage industry August of 2020. So August of this year will officially make for me. So I started, just a little bit of background. Um, Prior to getting into mortgage, I had a long career in sales and digital marketing. And once I got into mortgage, started as a loan assistant for my first year, kind of learning the ropes, and started writing my own business in September of 2021. Started with the online lender, moved to a local lender that is in what we call like a retail lender in 2023 when I was with Movement Mortgage. Left Movement Mortgage in March of this year, MG Home Loans. So over that time, I have helped over 450 clients secure more than $200 million in home finance. So I don't really say that number to brag or toot my own horn, because that's not really my style. But I do put those numbers out there, let you as real estate professionals know, and even with clients know, that there aren't many scenarios that I come across and been able to help people get through. And then outside of that, even with my team, in terms of my processor and my production assistant combined, we have over 20 years of mortgage experience. So even if there's something that I haven't personally seen, they've seen it, and they aren't versed in. CMG has an amazing operations staff where we can find the answer to anything that we need. Okay. So we use and leverage that experience to help align clients with real estate goals and broader financial goals through custom solutions. So um, that's, enough about me. Now on to what we're here for today, which is learning these topics. So like I said, I definitely want this to be collaborative. Ask your questions. We will have the Q&A session at the end. Uh, I'll definitely try to monitor it as much as I can. So if anybody has like a question, and you don't want to like jump on the microphone, you can definitely put it in the chat and I'll try to answer it, or you can save it to the end and we'll work through. So today's webinar is really going to be into 5 sections or 5 topics. Section 1, we're going to go over a pre-approval versus a pre-qualification, and how do you spot the difference as an agent, especially now. We all work on commission, with you guys having to do a lot of showings and driving these buyers around. One thing you don't want to do is waste their time and waste resources, right? Driving all around the city and you don't have a strong pre-approval or anything like that. So we'll definitely discuss first pre-qualification. Next section, we're going to talk about loan types. We are going to keep it kind of high level here, but we are going to talk conditional loans. We'll, hit jumbo a little bit, but nothing too major on those. We're just going to focus on really what are the common loan types we're going to see here. In section 3, we're going to hit deal killers, and what we can do as agents and loan professionals to help out deal killers and prevent those. Section 4, we're going to hit talking about mortgage without getting in trouble and staying compliant. And then the last section, we're going to just kind of talk about what to look for in a lender partner. How's that sound for everybody? Sound like, um, we need to cover, or is there anything else that you think we're missing?
Sounds good to me.
Yeah. Evelyn and Kimberly, thank you all for jumping on too. All right. So, section 1, pre-qualification versus pre-approval. So these are not all pre-approvals, or not all of them are created equal. Okay. So the first thing we're talking about when we talk about pre-qualification versus a pre-approval is what is a approval and what is a pre-qualification. So a lot of times you're going to hear a lot of loan officers or lenders, especially if a buyer who went to like an online lender, like a Rocket or a better.com or some of these, online, they're usually going to a lot of times give like that pre-qualification. What's that pre-qualification is really going to be based on self-reported information, meaning buyer, I go online and start the pre-approval, and it's gonna ask how much do you make. I put in $100,000, have in the bank, $20,000 in the bank. It's gonna do a soft credit pool. So a lot of times it's gonna pull maybe like one score just to get a pool there. It's gonna ask them like how long they've been working. So it asks all the information, and it'll be up to the buyer to self-report that. Uh, but that pre-qualification is not going to be based on any document verification or any underwriting. So it's really going to be based on the buyer just telling them. And how many times do we think that that's really going to happen, right? Even if it's not intentional, sometimes buyers, you know, what they put down, like I said, even if it's not an intentional thing where they're misleading, sometimes all that stuff isn't qualified correctly. If a potential buyer works a lot of overtime, and so the money they make, a lot of it is in overtime pay or bonus pay, but they've only been working at that job for 6 or 7 months. Like, yes, you may make $8,000 a month, but if only 4,000 of that is like your guaranteed pay, rest of it is wrapped up in overtime or commission, but you don't have the history to qualify that, we can't use that other half of it. Does that make so? But those things are what pre-qualifications are based off of. As with the pre-approval, a pre-approval is going to, so we're going to pull all 3 scores to get what we call your tri-merge score. We're going to verify your income. We're going to verify your assets, bank statements, last 60 days of bank statements, retirement statements, or whatever they're using for their cash to close and closing costs. We're going to pull their income verification. A lot of times we can do that electronically, but then we're also going to get the most recent, at least 30 days of bank statements and 2 years of either W-2s or year-end pay stubs to verify the continuance of income and approval. And then the bulletproof pre-approval is one that is fully underwritten. So at CMG in the closing, what we can definitely do as well, once we take it a step further past me verifying all the information for that pre-approval, we can go ahead and submit writing up front. And by submitting that to underwriting up front, what that does, the underwriter looks at everything, the underwriter verifies everything and gives us a fully underwritten pre-approval letter, which basically is the same as cash, right? So when you take that fully underwritten pre-approval letter, now with that, you can make offers that are 21 days or less in terms of closing, because all the underwritten is we're waiting on at that point. Once you go into contract, would be making sure the inspection is good, making sure that the appraisal comes in at value and that uh, is good. So here you're gonna see an example of what our like. So as you can see here, it's gonna have your loan type, it's gonna have your sales price, loan amount, and loan to value ratio. So of course it's a VA loan, so they don't have to put any down payment down. But you're also gonna see that with our pre-approvals, I'm going to let you know this pre-approval is based on review and verification of the credit report, the current assets, personal information, current income, and so we've done everything up front. I've reviewed it based on guideline, and it's also going to let you know what the final approval will be subject to, which is pretty much standard. Even if we do a fully underwritten pre-approval, that final approval still will be sub verifications, because basically that final approval is basically saying that you're clear to close. Does that make sense to everybody? Does anybody have any questions, or have you all seen like a pre-approval letter that doesn't have any of these things, or partner and have questions based off of some experiences that you've maybe had?
I have a question. It doesn't come from my personal experience, but there was a time someone I know is a real estate investor, and they spoke to somebody, and they said, "Yeah, I'm pre-approved," but it was a falsified pre-approval letter. So if somebody
Mm,
says they have a pre-approval letter, how can I then take that and legitimize it?
yeah, great question. Great question. So basically, the investor told you they were pre-approved, but it's something that they um I don't want to say made up, but it wasn't valid essentially.
Yeah, their client falsified a pre-approval letter.
Uh
Yeah.
got you. Got you. So yeah, what you want to do, especially if it's from um a lender that you don't know, or maybe you don't have a relationship with or anything like that, call them. The pre-approval letter should definitely have the loan officer's information on there. So if it is something that you're concerned, or like I said, you don't know them, you don't have a relationship with them, or whatever, some uncertainty, give the loan officer that's on the record a call and walk through the file, ask them. They may not, or probably won't, give you like specific like financial detail, just because it's kind of like personal information, but they should definitely that they have um basically verified all the things on the pre-approval letter.
Right.
And based off the have with that lender, um, if you feel like it's, what they said is legitimate or supported, then you roll with it. If you don't still feel like iffy about it, don't be afraid to recommend that your buyer, maybe your loan partners that you have a relationship with. You don't have to frame it in a like a content, right, to create a rift, but you can just say, hey, I recommend that my buyers maybe get a second opinion. I have somebody who can give you a second opinion you want it, and go from there. But ultimately your reputation is on the line. And a lot of times that's what, as a client, as a, or even a seller, they're looking at it as one transaction, right? Like, this is the one transaction. I'm buying this house, I'm selling this house, and then I'm not a house, or I want to sell it. But on our end, um, the reputation matters, right? So like if you're presenting a offer and it's with a bad pre-approval, and then that falls through, now, that's going to kind of be stuck with you. Same here as a lender. If I'm writing bad pre-approvals and I can't make it to closing, if you as an agent or that seller agent sees home loans come across on an offer, you're going to be hesitant because, like, man, I heard Jay doesn't close on time, or I heard, you know, Donovan's buyers aren't legitimate, or whatever. So definitely take that into account, and don't be afraid to verify these letters that you're getting. Does that make sense?
Yeah, that makes sense.
Good deal. All right. So section 2, uh, loan types. Any other questions? My bad. Any other questions on pre-approval letters? Sierra and Kimberly, y'all have any questions on those?
No, I'm good. Thank you.
Perfect. Perfect. All right. Um, all right. So loan types. Loan types are next. So, like I said, this is going to be on a in regards to loan types. So what we're going to focus on in this section, we're going to focus on government-backed loans versus conventional loans, because the common loan types that we're going to see. Yes, of course, we have jumbo loans, we have the non-traditional products, like bank statement loans for entrepreneurs, um, DSCR loans for investors. Like, we have all those things, but really these four are really the ones that we're going to interact most with the majority of the clients that we see. So you have conventional loans, which are basically loans that are backed by Fannie Mae and Freddie Mac, which Fannie Mae and Freddie Mac are the like underwriting pretty much for all of the mortgages in the United States. You've probably seen them in the news a lot lately. They've, ever since 2008, been under what they call like a conservatorship through the U.S. government. So even though they are like private entities, they're kind of like shadow owned, I guess you can say, by the government, to make sure that basically a housing crash again. But they pretty much write their own underwriting standpoints, or excuse me, have their own underwriting guidelines that they underwrite off of. What ends up happening is when this conventional loan is sold, or excuse me, when the loan is closed on our end of the transaction, typically Fannie Mae and Freddie Mac, they sell those loans to different investors, or um, they hold them, but essentially that's what they are. It's like a secondary market, and those loans are then sold on that market through Fannie Mae and Freddie Mac. For conventional loans, credit score minimum is 620, but generally for better pricing, 700 or higher is kind of ideal. Um, Also, just from an approval standpoint, usually 680 or higher, best for approval. 700 or higher is best for pricing. Down payment's going to vary here. You got anywhere from 3% to 20%. So if you're a first-time home buyer, have not been on a deed to a home in the last 3 years, then you can qualify as a first-time home buyer and put down 3%. It's approved, and then you can go all the way up to 20% or more. But 20% is kind of where it stops, because people don't have to do PM once they hit 20%. So conventional loans, who is it best for? It's best for W-2 buyers with strong credit and savings. Okay, so that's really going to be your ideal market for conventional buyers. And then for you guys, just when you're thinking about it, usually is great for competitive offers, because there are fewer things that have to be done from an appraisal standpoint as opposed to government-backed loans. So the appraisals are usually easier. They've kind of changed some appraisal stuff on government-backed, almost pretty similar to conventional loans, but still conventional is a little bit easier. And then a lot of times sellers sellers view conventional loans as easier products as well. And then the call like the government backed loans. So conventional is, like I said, on its own. FHA, VA, USDA, government backed loans, which essentially is just like they said, these are all backed by the federal government. So if something happens, that loan isn't paid, or whatever the case is, the investors can go back to the government, and the government basically pays them for the loss that they. So with FHA loans, which FHA loans are obviously going to be very popular. If you haven't, done or heard about one yet, of course, FHA, the credit score minimum is 580 to put 3.5% down. A lot of lenders, some lenders don't do it, but you can technically go down to 500 with a FHA loan, but they have to put 10% down. So if they want to do 3.5% down, has to be 580 or above. 620 or above is ideal. 620 or above, typically you won't have to do any manual underwriting. A lot of FHA loans, you have to basically have manually approve it under 620. But that's like a thing for us, but just for you guys, sometimes that works there. Who is FHA loans best for? It's going to be best for first-time home buyers, credit borrowers, basically anything, like I said, under 680. Usually FHA is going to be great for, and then higher debt to income ratio, because with the FHA loan, you can go up to 56% from a debt to income ratio standpoint. Whereas with conventional, usually 50% is the maximum. A lot of times, the automated underwriting wants you to be under 43%. And then FHA really and truthfully too, especially in this climate, like this rate environment, regardless of the credit score, like even if it is high 700, 720s, a lot of times I recommend for people to do F. And the reason being is because since they are government backed, the rates are better than conventional loans, even with high credit score and high earning, like well qualified buyers, the rates are going to be better on the FHA loan because it's government backed. Now, in patients with the FHA loan, the appraisal is more focused on property condition, and it requires, so no matter what the credit score is, no matter how much you put down, PMI is going to be required for FHA loan. If your credit score is higher, then that mortgage insurance is going to be fairly lower. And what PMI is, that mortgage insurance, essentially how I was talking about the government or the entity basically buying or paying for the loan if something was to happen. Private mortgage insurance is kind of what helps offset that, right? So even on a conventional loan, if 20% down, you're going to have private mortgage insurance until you reach 20%. With the FHA loan, you're going to have that private mortgage insurance regardless until you refinance out of a FHA loan and go into like a conventional loan at 20% equity. And with FHA, like I said, the agent tip here, if you are looking at putting offers on older homes or homes that may need some, then you have to watch out for potential appraisal issues, because they do have some different things they look of property conditions, lead paint things, safety issues, structural issues that are a little bit more focused HA versus conventional. And then the next loan type is going to be VA loans. So, like it says, right, active duty, veterans, military spouses in some points are eligible for these. Big thing here, 0% down. Okay, 0% PMI. So that's really the great thing about a VA loan. Credit score varies by lender. Generally 580 plus. Once again, 620 plus gets us more likelihood to get an automated approval instead of having to do a manual. And then this is for eligible military buyers with stable income. And because they have no PMI, a lot of times it does give better buying power. It allows for more in terms of seller concessions. Seller concessions can be used outside of paying for closing costs like it is with any other loan. And then lastly, we have USDA loans, which in the Charlotte area, like really a lot of like Cabarrus County, Mecklenburg County, we're not going to see a lot of USDA areas, but once we get out to like some of Gaston County, Catawba County, Lincoln County, maybe some of Iredell County, we're really going to still see some of those USDA areas be available. So like I mentioned, or like I just hinted, it is location based. So it does have to be in the USDA, which can be looked up and verified. They do have household income limits. So those household income limits are going to vary based off of total household size. You don't have to put a down payment down. Credit score minimum is 580. 620 is per automated approval. So as you can see, that's the theme with government housing. Excuse me, not government housing. That is the theme with these government loans. Minimum credit score, but 620 is always going to be preferred. But anything under that 620 to that 580 range, here and some other lenders, we do have the ability to do manual underwriting on those. If you're going like a lot of new things like that, or even banks, 620 is their minimum. They don't do manual underwriting. So that's definitely a plus with going independent mortgage company such as myself and CMG. Any questions on those? Like, how many of you guys have maybe kind of run into some of these different loan types or heard about them or had any conversation about them?
I just recently heard about it because a lot of people can sometimes be concerned with things that can come with government-backed loans like FHA, and they
Mm-hmm.
prefer conventional over FHA loans.
Yes, that is true. Just like I was mentioning, um, just like I was mentioning to you, right? So that is some of the some of it is like misconception. Some of it is kind of like way of thinking that because it is government backed loans, you're going to like automatically run into these appraisal headaches or whatever the case is, or whatever the case is. It's not as much a case anymore, but that is something that sometimes you have to get past from the professional side of it, right? But it is a thing that going back to preparation, right? If we fully underwrite that pre-approval, um, then we kind of cut out that whole time frame of it, taking this long. We can close in the same amount of time on an FHA loan as we can close with a conventional loan, even with a VA, right? Like as long as we don't have issues. The big thing with a VA loan that I think sellers and seller agents get to, like specifically, is the VA loan. It doesn't allow for people to closing, right? So say if it's a thing where like you may see something that needs to be fixed on a conventional loan or even what it is with the FHA loan, you may be able to put an addendum in that the seller's going to give $5,000 closing to fix whatever the issue is. You can't do that with a VA loan. If it's something that needs to be fixed, it has to be fixed before. So kind of getting ahead of it, talking to the seller's agent, kind of getting an idea of what the house will qualify for does help. normally will know, like, hey, this may present an issue, this may not. So definitely, like I said, it's kind of a, but we can get around that with basically being prepared and having things airtight.
Right.
All right, so the next thing we're gonna go over, four real mortgage mistakes that can have major impact and blow up contracts. I'm pretty sure even if you haven't dealt with it on your own, stories about deals blowing up, right? I'm pretty sure we can all agree on that. And it really comes down to, really only a couple things that usually make that happen. But these are four major buyer mistakes that can kill deals. Buyer switches jobs during the process. Very bad deal. Large deposits. So with this one, this is going to be major because any anything that's in your account, if deposit, which typically a large deposit is more than 50% of whatever your gross income is for the month. Anything that has a large deposit, it has to be seasoned, which means it has to sit in the bank account for 60 days before it can be qualified, unless we can verify it. So if it's a thing where, um, say you got a bonus at work, or let's use a different example. Say you went to Harris or went to the casino and you hit big, right? Hit for $10,000, or you hit a scratch off and you deposit down. As long as you have the receipt or you have the proof of the then we can use that. But if you don't have any proof of it, or if it's just cash that's been sitting in the house for the last like 8 months and you try to put it in your account, we're not going to be able to use. So if the underwriter has to back that out, once you get into underwriting, that could severely affect your cash to close or what you have available for the transaction. And if you end up not having enough available for the transaction, then it's gonna severe. Another thing that is most dreaded, large purchases on credit. So we always talk about like the big thing, buying cars, right? Like, which people still do, but it could be other things like purchasing furniture, um, just any kind of large transaction using credit, because we're going to continue to run like credit check throughout the process when you're in escrow and processing. So if something comes up on that credit report and now your credit different, we're gonna have to count that, right? And if it messes up your debt to income ratio or it throws you off of the debt to income ratio, then that's gonna. So definitely want to look out for large purchases on credit. And then um the other big one is not maintaining status. So this one is important because this one is kind of, in my opinion, overlooked. So take, for instance, say we get somebody pre-approved, they're shopping for 30, 60 days before they find the right house, right? And we need to make sure that that buyer understands that whatever they had in the bank, whatever the credit score was, whatever the utilization is, all those things need to stay consistent or pre-approved the time that they close. So I actually ran into an issue with this one time where we had got the buyer pre-approved. They were house shopping for days, and then when it came time for us to go into processing and get ready to close, they they used money that was in their savings account, so they didn't have the amount of reserves that they had when we originally got them approved, and different things with their credit. So their debt to income ratio had become different. So when even though we had them like fully underwritten up front and verified, once we got into processing and those new credit scores, done and everything was different, now they weren't approved anymore. So luckily we were able to get it fixed in different accounts. We were able to kind of do some different things, but it just created a very bad experience. We didn't have to like push closing back or anything like that, but it just made a bad experience, right? And what you will definitely see, if you haven't had a transaction or anything like that before, one thing that I guess for our and always I did, but it is what it is that if the client has a bad experience, even if it's caused by maybe something that they didn't do well or them not getting documents in on time or anything that wasn't in our control, the experience is going to be put on us as their professionals, right? Like, oh, Jay didn't let me know this or Sierra didn't let me know this or nah, I mean, we told you just didn't do X, Y, and Z. So, like I said, these four things are big. So what we can do, basically, definitely ask kind of what the situation is. Are you gonna have to make any deposits or do you have any large deposits? Definitely coach them up. And that's where we come in as a tandem to coach them up, make sure that they are properly to expect what they need to do during the process, and then use a mortgage readiness checklist, which I'll definitely, after everything is over, I'm gonna send you a mortgage readiness checklist for you to be able to use so you can see on what to do. But those are definitely some things do. It really comes down to educating and just making sure that they stay in the best situation. Have you guys heard or had any heard anything outside of the four that we just talked about? Nope. Good, 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 good. Well, like I said, education kind of trumps all when it comes to that. All right. And then section 4, this one is really just going to kind of be about structuring your conversations, right? Like how to have conversations compliantly without necessarily going and taking to the strong point. So three big things to do when you are having conversations about mortgage is guide, but don't lies. So just like, for example, we were talking about guidelines, right? So if a client asks you like, man, how much now for this house? Because 9 times out of 10, the client's going to come to you as the real estate agent first, and they're going to kind of ask a question regarding, because nobody wants a mortgage, but everybody wants a house. If that makes sense, right? Like nobody's like, man, I want to go ahead and get 15 years of debt or whatever to buy this house. They just know they want a house. So if they do come to you with those questions, God, don't advise. Like, hey, for this, like if we're doing the FHA loan, the guidelines say you can put 3.5% down, or you're gonna need 3.5% down. You're gonna need at least a 580 credit score. Basically based talking on the guideline, but not necessarily advising them about a loan product. Framing is gonna be important. Like I said, hey, you need X amount down or you need this credit score, but let me connect you with to help that, right? Or you can push it along and say, hey, stronger or qualified buyers usually want to get pre-approved, and just doing that so that way you don't get caught up in the weeds of trying to talk the finance, because even a lot of agents, like as you look around on social media or just within your offices or your brokerages or whatever the case is, you want to get in the weeds of financing and the mortgage side and kind of want to be lockstep with those. My on this and just like a compliant way is we work in tandem, but I'm not an agent. just like you're not a loan officer. You can talk high level, but in best um the best client is to let you speak to the professional on that side, right? So kind of the same thing. That way you're not caught in saying something that may end up being, because they're gonna go back and say, oh, well, Chelsea told me this, or Donovan told me that I can get qualified with, so why did I not get qualified? Like, so definitely refer that to the person who can help them out. So what you could say, somebody asks you a question like, Sierra, how much do I need down? I can give you a general overview based on what I see in the market, but you with a lender who can tell you exactly what you qualify for and what loan fits your goals best. Can I connect you? Can I group chat? Can I, put you in the email chat to get you over to them? Can I send you the app? Keeps you out of it, keeps you out of blame, and just keeps everything smooth. And like I said, above all, keeps the buyer experience great. Any questions on that, or how to talk? I said if you stick to guideline and general information, you're good. But anything above that, you're kind of starting to get into some muddy waters that you probably don't want to. Any questions there? Hey, either I'm boring or I'm good. I don't know which one it is. So I guess I'll just go with good. All right. So the last part here is what to look for in a lender partner. So with lender partner, thank you, Kimberly. Thank you. Somebody's on my side. Um, so what to look for in a lender partner. So really how lender relationships, right? Because I know, like I said, in your office, your brokerage, you may have lenders that you have to go with because they have what's called like with your brokerage, and you're supposed to send deals to them, or they may have a desk in the office or whatever the case is, or it might be somebody who your mentor uses a lot. Your lender is an extension of your brand. So you want to make sure that you have synergy with the person that you are seeing, referring business with, right? Because like I said, when the client thinks about or they think about their experience, they're going to think about the total experience. And it's still going to come back on you as, like I said, 9 times out of 10, you are the first point of contact for their home buyer journey. So whoever you refer them to from there is of you. So you want to make sure that you have that synergy. So it could be somebody who, if your mentor or whoever's in your office that you kind of look up to, 6 deals a year, and this is their go-to person. But if it doesn't fit with you, like, it doesn't fit. What you want to look for in a lender partner, it really kind of comes down to, I would say, I mean, it's the connection is one, right? Like, I know you guys vibe together, you know, kind of what the feel is. If your goals align, kind of just some, but just from a professional experience, or you want to um, make sure they provide a strong client experience. Okay, so that means a thorough pre-approval, educating your borrower on not only what's coming next, but what they're really getting into. Um, educating them on the loan product, why this loan product is best for them, why they need to save X, Y, and Z, why they can't, use this program, or why this down payment assistance program doesn't work, or why this. Want to make sure that they provide a strong client experience. You want to make sure that they are responsive in communication. I've seen where deals are made or lost because of communication. Communication from the loan officer to the buyer, or the loan officer to you as a buyer's agent. but even that's communication from loan officer to seller's agent may do, especially if it's a multiple offer situation or something competitive. The seller's agent is probably going to reach out to the loan officer, ask questions to verify um, things on the pre-approval, to verify things in the offer. Like, hey, can you really close? Are you for this borrower? Is your underwriting local? Like just different things. So I've seen deals where communication or not being responsive has killed deals. I, where previous loan officer wasn't responsive and seller's agent is mad to switch last minute because the buyer needs somebody who's responsive, right? Like I've been there. One thing I definitely do on my side contract, or excuse me, not when we go into a contract, when we put it in an offer, I always ask, and even in my pre-approval, like when I send out my email for ask my referral partners, hey, loop me in with the listing agent as soon as you go to put in an offer, because I'm going to proactively that listing agent, introduce myself, introduce our process, and verify our buyers, right? So responsive communication is key. Marketing support. Now that can look different depending on what your marketing is going to be. It doesn't always have to be money, right? It doesn't always have to be like, hey, buy me leads or leads, but just different lead generation tactics, whether that be like just drew a blank, whether that be like home buyer seminars or just different like co-branded events, door knocking, um just different things in terms of like working on your data, whatever that lead generation tactic is. Any type of co-branded tools that they may offer is going to be big as well. And then the education, not just execution. Like I said, closing deals, closing fast, like we all do that. Like that's kind of like the baseline minimum a loan officer, but you want to make sure that not only are they invested in the education of your buyers, but also in the education of you as your business partner. So those are definitely four strong things that I would say to look for in a lender partner. Um, Kind of how I help my agents win, kind of going in on that. Oh, anybody had a question? Good. Okay. So some of the things that I do here with the Closing Table Collective at CMG Home Loans, it's not just about building it's about building your business, not just closing a loan. So what I offer and how I help agents win, like I said, bulletproof pre-approvals. I'm going to verify all documents. We're going to get those bank statements. We're going to get verify the income. We're going to pull the hard credit before I issue a pre-approval letter. Even if it means it may take a couple more days because we need to get something verified. My thing is I'd rather it take a couple more days up front or a couple more days going up front so we can close on the back end, because that's ultimately what matters, is being able to get to closing rather than moving fast, issuing a week pre-approval, and then you and go under contract and we can't make it to the closing table. Also offer a 10-step system. So I have a proven process from first contact to the closing table. It gives less chaos, more control, more scalability. We have the legacy loop, which the legacy loop is our end-to-end system, which turns one client into 5 with a referral first repeat business mindset that's built into every deal. We want to make every transaction, we want to make every interaction turn into a end-to-end cycle, which creates more business. Co-branded marketing tools, which we're going to leverage funnels, buyer guides, and automation to attract and convert. And then that I have, call it the 7X digital agent growth support outside of mortgage. Like I mentioned, I also own a digital marketing. So when it comes to wanting to do more in terms of your digital marketing, websites, things like that, we also have I can bring to the table for you as well. Okay. So that's just a shameless plug about us at the Closing Table Collective, how we help our clients win, not only just as winning deals and closing loans and making money right now, but really building a scalable business that you can make real money in this industry. So, with that being said, in terms of scripts, checklists, and the replay, for being on with me, I definitely want to thank you guys for time. It's valuable and appreciated on my side. So, within the next, I would say 24 to 48 hours, you are gonna get that mortgage readiness and red flag checklist that I mentioned earlier. You're gonna get a buyer pre-approval script that you'll be able to leverage and use with your buyer when they're pre-approved, and transition them from pre-approval into shopping, and kind of give them those next steps of what to look for. And then you're also going to receive the slide deck and replay link for you guys to be able to go back to reference when you need to. So those are things you're going to get as just a thank you for spending an hour with me today. Also, if you do want to book a strategy, like a lender strategy session, just to talk more about like your business, how we can help you grow, kind of where you're looking to go, move to the second half of 2025 and beyond into 2026. I want to see how we can add value here with the Closing Table Collective into that goal. You can scan the QR code that's there. I'll definitely drop the link here as well for those who are, potentially like looking on your phone. I'll definitely, drop that link for you too. So that way you can book a strategy call here with me and, look at how we can help you grow your business. All right. So just real quick while I'm getting that up for you guys, like I said, I want to spend this here with any like questions that you may have or any Q&A. Is there anything that you guys have that you want to discuss, or, just, you want to talk about a little bit more? All right. Everybody's good.
Yes, I thought this was very informative. Again, thank you. I saw someone post like thank you for like educating us in here, I think. And I just wanted to go off of that and say that it was super informative. As someone who's new in the industry, I
Oh,
feel like
great.
this helps a lot because I've already gotten my first pre-approval, but like
Nice.
learned this stuff, but just like kind of the way that you put it all together, I feel like makes it really click now. So I appreciate it.
Perfect. Perfect. Well, definitely congratulations on your pre-approval. And Kim, thank you. I'm trying to do like 3, 4 things chat, but definitely thank you all for joining, and glad that I could provide some value to you all, and you did find it useful. So hopefully the 2 things you can take away, like you says here, now that you kind of see some of the background behind the pre-approval, hopefully that helps you out, and then go, you know what to look for. I did drop that information in the chat and the link that anybody wants to get it or book a call. And hopefully we'll be doing these often. So probably like every 2 weeks or so, 2, 3 weeks, we'll have a different topic that we'll be covering. So I will definitely keep you all informed of anything that comes up. And then in the meantime, of course, I'm gonna put in the chat here for anybody who doesn't have it. You can like text me, call me with any questions, and I'm here to be. If there are no other questions, thank you guys again, and I look forward to hope. All right, guys, y'all have a good one.
All right, you have a good one. Appreciate it.
Have a great one, everyone.
All right, thank you.
No problem. Bye-bye.
What'd you think? Hello?
Hold on.